if I set up an exercise where, well, let's say you had a coin and you thoroughly analyzed this coin. Looks like a normal coin, but you thoroughly analyzed it and found that it was unevenly weighted. What? Yeah, found a coin. Okay, found your coin. Yeah, it was unevenly weighted on the head side over the tail side, and you flipped it 1,000 times and found that it's going to come up on a percentage basis, tails 70% of the time. In other words, heads is going to flip down because it's weighted, and it's going to be tails 70% of the time, and heads 30% of the time. And, you know, just happen to get into a situation where someone says to you, you know what, they let you flip that coin, your coin, and they say, because you say to them, well, you know what, I'm really good at flipping coins, and I can do better than 50-50. And the person says, okay, I'll give you $1,000 for every time you're right, but you pay me $1,000 for every time you're wrong. Now, what you're going to is you're going to a situation where, let's say over 10 flips, where you're gonna flip the coin 10 times in a row. Now, first of all, what is the likelihood? What is the likelihood that you would be right all 10 times in a row? Well, in this case with the weighted coin, it's better, but under a normal coin, it would be highly unlikely you'd be able to correctly predict 10 flips in a row. But you know that you have an edge, a probabilistic edge. So to take maximum advantage of the edge that is built into that coin, how are you going to bet?
You betcha.
What? No. How are you going to bet? What are you going to call on each flip? You're going to call tails 10 times in a row, right? You're not even going to think about doing anything but calling tails 10 times in a row. What are you expecting on each individual flip? No. What are you expecting on each individual flip? You don't know, right? But here's what you're really expecting. One, you don't know, but here's what you do know. You do know something. It's either going to be head or tails. You know that it's either going to be head or tails, okay? And you know that heads are going to come up and tails are going to come up. So in essence, you are expecting both heads and tails. You are going to go into the 10 flips expecting both heads and tails. So if you call tails and heads come up, are you wrong? Yeah, you called tails. Why aren't you wrong? You called tails. Why aren't you wrong? What?
You're waiting for the average.
Oh, you're waiting for the average over the series of flips. In other words, you're not wrong on each individual flip because each individual call is serving a higher agenda. The agenda meaning I want the 70% percentage, meaning that I'm going to end up with $3,000 most likely on average. So every time I call tails, I'm calling tails 10 times in a row, but every time I do and a heads come up, am I going to feel like a loser? Am I going to think that I was wrong? No, I'm serving a higher agenda. I want the 70%. When we develop and test an edge and find out that it comes up with a 70% win-loss ratio and say that I'm going to take the next 20 trades, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Am I going to care about the sequence, the wins and losses? Is it going to matter what the outcome to each individual trade is? No. All I'm looking for is the bottom line at the end of 20 trades. That's it. This is what this is all about. When you can learn to think this way at the very core of who you are, you will be able to execute your trades flawlessly. It wouldn't even occur to you not to do exactly what you need to do in each and every instance. To the degree to which you cannot do it, in each and every instance, is the degree to which you still don't believe you don't have, as a core part of your identity, a probabilistic or functional belief system and probabilities. And I'm going to show you how to get it installed. Go ahead. Bet on what? Bet on what? Okay, yeah.
You're betting everything's exactly the same.
Yes, correct.
Okay, I'm betting on that.
No. Remember, I set the exercise up very specifically. I set it. What can't work?
Different amounts.
No, I just said no. Keep something in mind. You're taking out of context. Okay, you're applying a principle to something I'm not talking about. All I want to do, all I'm doing, I'm talking specifically about how to play this. How to play this in a sense from a money management perspective. I'm just doing it from the perspective of what our emotional response is. This is just all based on emotional response. In other words, what's our perspective in relation to, in other words, we're operating out of certain perspectives, it will dictate a certain emotional response. If I'm operating out of a probabilistic perspective, then there's nothing to be afraid of. Yeah, this all has to do with our emotions and our response. In other words, understanding that what we believe is going to determine how we see the world. We see the world through our beliefs. The decisions we make are based on what we believe in relationship to the information we're exposed to. What we experience, in other words, how we feel about the results, or how we behave, will be consistent with what we believe. And how we experience our results, meaning what our state of mind is. Are we happy? Are we regretful? Are we elated? Are we joyful? Are we fearful? In other words, how we experience our outcomes is also a function of whatever beliefs we're operating out of. What we want to do is get to the point where our beliefs are completely aligned with a probabilistic perspective so that we can do exactly what we need to do, when we need to do it, unencumbered with fear. Because here's what happens when we're operating out of fear. I'm going to give you a real quick example, and I'm going to go into the whole belief system in more detail, and then set up the exercise. Okay. We got support, we got resistance. Market comes back up, nice trading range, comes back up to resistance, coming down to support, okay? Now, I'm looking at this chart and I'm saying, okay, the market rallied off support here, essentially means what? An imbalance between the buy and sell orders. Why? I don't know. Who put the buy orders in to absorb the sell orders as it was coming down? I have no idea. I don't care. I don't need to know. It doesn't make any difference. Remember the example yesterday where, I had my customers buying support on an intraday basis, buying support on an intraday basis, and it fell apart the next time because the guys who were supporting that price in the bond pit were out to lunch. And so as a result, their orders did not go in, their buy orders weren't there to go into the inventory, and there were more sell orders than buy orders. So whoever was selling it each time, in other words, whatever reason they had to enter these sell orders, they were not met with any resistance. I'm not resistance in the sense of resistance. In other words, prices take the path of least resistance, and there weren't enough buy orders. There were enough buy orders to absorb those sell orders, and so and then more buyers came into the market or whoever, and then the market came down again. They were out to lunch, so it fell apart. Now here we're in a situation where now the market's coming down to support, and I'm a typical trader operating out of the fear of being wrong, the fear of losing money, the fear of missing out, the fear of leaving money on the table. Okay? And as a result of not having learned how to think in probabilities, or having realized that this is what this business is all about, that analysis will not prevent the experience of me tapping into the accumulative emotional pain of what it means to be wrong and lose money. That analysis cannot prevent that from happening. So what I have to do is I have to take it out of a right or wrong, win or lose context. And this is what we're doing here. We're taking your trading, we're redefining it so that you have no reason to associate the experience of an outcome of a trade with what it means to be wrong. That doesn't mean that doesn't mean it has anything to do with whatever memories and beliefs you have that define what it means to be wrong for the rest of your life, or in any other part of your life. It just means that for trading, you're realizing this has nothing to do with being wrong. This has nothing to do with losing. You are incurring expenses. So you're not a loser. Take it out of the right or wrong, win or lose context, and you're going to experience freedom. And here's how: because of the way these fears impact our perception of information and our behavior. Remember I said yesterday that fear causes us to focus on the object of our fear so that we end up experiencing the very thing we're trying to avoid. We'll actually create what we're trying to avoid just based on what we're afraid of. So the market gives us, at the most fundamental level, the market gives us two kinds of information to consider. There's a whole array of information, obviously. But at the very most fundamental level, you take it down right to the core, we have two types of information, two distinctly different types of information to consider. What are those? What would those two types of information be? Well, sort of upticks and downticks. Upticks and downticks, if that's simple, right? There's an uptick and a downtick, an uptick and a downtick. Uptick, 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 downtick, downtick, downtick. Okay? Now, as we learn about behavior patterns and trading patterns, we learn things, we learn to make distinctions in the collective behavior. Distinctions being like, what do we call this? And from a technical perspective, what do we call this? An uptrend. And what do we call this? We call this a downtrend. Okay? So we actually learn to make these distinctions in the market's behavior that have meaning. Before we learn what the meaning of these patterns are, they are essentially meaningless. Meaning that we can, before we learn the distinctions, we can look at a chart and it's just literally random information that has no meaning until we learn the distinctions. So in essence, we build up these distinctions so that we can recognize what's already in our brain outside of us. So when it appears, we can say, yes, I know what that is. You guys with me on this? And so every other distinction that is possible in the market's behavior that we haven't learned about yet is essentially invisible. You guys with me on this? If we haven't learned to recognize it, it's invisible. So there are always opportunities available that are in essence invisible simply because we haven't learned to make the distinctions. So now I'm a typical trader who has learned to make this distinction and define certain patterns as an uptrend and a downtrend, and it has meaning to me. Because once an uptrend starts, I'm saying that, you know, it's like I'll operate out of the principle, don't fight the trend is your friend, until something happens to say otherwise. And what's the real underlying meaning between the trend is your friend? You don't fight your friends, do you? You rarely get in fights with your friends. So don't fight the trend because it'll make you money. That doesn't mean you can't pick lows and pick highs. But trends are a good way to make money. And it's a distinction in market behavior. However, I'm a typical trader, and I'm operating out of this fear of being wrong and the fear of losing money. And so, as the market's coming down to support here, I want to get into this trade. And so, I put a buy order in, you know, somewhere here, and get filled. Okay, I put a buy order in, the market goes up a little bit. Now, as a typical trader, I probably will not have predefined my risk. Because as a typical trader, it's like predefining the risk sets up an irreconcilable contradiction for me. Okay? It's like, I'm not getting into this trade unless I think it's going to work. Now, if I go through the exercise of telling me how far am I going to let this market move against my position right here, to tell me that it's not going to work. In other words, in essence, it forces me to gather information that would tell me why, or tell me that this trade might not work. And I might gather so much information that I talk myself out of the trade. Has anybody ever talked themselves out of a winning trade? Okay, so you know, and talking ourselves out of a winning trade that ends up working is most of the times more painful than getting into a trade that just doesn't work. So if I've gone through this process of having talked myself by going through the exercise of trying to define the risk, meaning the dollar value that I have to assign this trade to find out if it's going to work, the dollar value of the distance between where I get in and structurally where I get out, and I've talked myself out of a trade in the past, chances are all I'm going to do is make sure that before I put my buy order in, I am really convinced this is going to work. Otherwise, again, why am I going to do it? So, in essence, there is no risk. I'm not expecting to lose. I am not expecting to lose. So, the market starts to go in my favor, and you know, then it starts to do this, you know, this. Now, remember I said the market gives us two fundamental types of information to consider, upticks and downticks? I don't want to be in pain, do I? I don't want an experience that taps me into what it means to be, all the accumulated emotional energy of what it means to be wrong, and my memories of what it means to lose. Now the market's giving me two types of information to consider. It's giving me upticks and it's giving me downticks. If I don't want to tap into what it means to be wrong and what it means to lose, what of the two types of information that I'm being offered, what is going to create or what is going to have the most significance in my mind? No, you're not following me. You don't want to be in pain, people. You don't want to be in pain. Well, no. This is an example. Don't get to that yet. I preface this with this is the typical trader. This is not based on your new awarenesses of probabilities, okay? Okay. What of the information I'm being offered, I'm going to place more significance on one type of information than the other because of what it's going to mean to me emotionally. What information am I going to place the most significance on? The upticks. Why? Because the upticks take me out of pain. I'm expecting it. In other words, I'm expecting to win, and the upticks are taking me out of pain. So, for example, every series of downticks, I'm in pain. Every series of upticks takes me out of pain and gives me a sense of relief. Downticks, pain, upticks, relief. Downticks, pain, upticks, relief. Oh, it's finally all over. It's finally all over. But in the meantime, I'm getting a predominance of more downticks than upticks. In other words, I'm placing an inordinate amount of significance on the value of the upticks in relationship to the downticks, in essence distorting what I'm actually seeing. I'm not actually seeing a downtrend. The downtrend has become invisible to me. I am capable of perceiving a downtrend. It exists in my mind as a distinction, but because of my unobjectiveness, because of the way my fears are impacting my perception, I am actually not seeing a downtrend. The downtrend is invisible to me because all I'm really seeing are these upticks, upticks, upticks. And so here I'm afraid of being wrong, and I'm actually creating the experience. I am afraid of losing money, and I'm actually creating the experience. It's all going on inside my mind. Eventually what will happen, and I went over this just a little bit yesterday, eventually what will happen is that this market will go down so far that because I'm just not operating out of the fear of being wrong here, I'm also operating out of the fear of losing money, that my fear of losing money will become stronger than my fear of admitting that I'm wrong. Because once I admit that I'm wrong, I get tapped into the pain. As soon as I come to the threshold of admitting, okay, I'm wrong, I get tapped into the pain. And what's shielding me from that is the fact that so far my threshold for losing money hasn't been hit yet. Because when the fear of losing one more dollar becomes greater than my fear of admitting that I'm wrong is when I'll get out of the trade. And then as soon as I get out of the trade, with nothing at stake any longer, I'll look at this downtrend and say, why did I just sell? I didn't sell because this distinction was invisible to me. This happens in degrees. Like this is an extreme case, but this happens in degrees in virtually every trade we put on until we work through these fears. So let's say just the opposite happens. Let's say, instead of the market doing this, the market, does this. Now, who hasn't been in a trade, in a profitable trade? Now he's getting exactly what he wants. He's getting exactly what he wants. Now, how far are you going to think he's going to let it? How far do you think he's going to let that go in his favor? What? Oh, no way. No way. How many times have we been in a winning trade where the market came back and took our profits away and ended up in a losing trade? Happen enough where, for example, he starts placing an inordinate amount of significance, in this case, on the downticks instead of the upticks, okay? Okay? It's like, uh-oh, the market's taking my money away. Uh-oh, the market's taking my money away. Uh-oh, the market's taking my money away. He'd never get to that level anyway. You'll probably blow out of it, right in here somewhere. So afraid of leaving money on the table that that's exactly what he ends up doing. We can't be effective traders operating out of these fears. we have to find a way to operate out of a carefree, confident state of mind. Now, Johanna brought up something just after the break where she thought I was saying, or maybe implying that what we have to give up both the idea that the negative and the positive, meaning that that trading doesn't really have anything to do with losing, so we don't have anything to be afraid of. That trading doesn't have anything to do with being wrong, so we don't have anything to be afraid of. But on the other end, that we also have to neutralize our excitement or our happiness or our joy from winning. Not the case. Not the case at all. People who play craps, they're spending money to have fun. They like being surprised when the machine randomly pays them off. That's fun. So no, we're not giving up the positive, but there is an issue that we have to address. There is such a thing as overconfidence. We've got confidence, and this is confidence, like this is fear way over here, and then beyond fear is terror. These are states of mind. They're all in degrees. And then beyond confidence is euphoria. Euphoria is a dangerous state of mind to be in as a trader. So what I am saying, making a distinction that yes, you do not want to be trading in a state of euphoria. Because in a state of euphoria, the risk doesn't exist. When we cross the threshold into a state of mind of euphoria, we don't have the capability of perceiving risk. And then we'll end up doing all the things we used to do when we believed the risk didn't exist in the first place. And if I'm implying that you have to develop some pretty sophisticated skills of self-awareness to be able to recognize when this happens, yes, I'm implying that. There's a lot about this business that, there's just no getting away from the fact there's a lot of skills to learn. And they're all psychological. After you learn how to read the markets, everything is psychological. Everything. That's why you hear a lot of people talk about, trading is one of the best vehicles for growth and personal development that there is. There really is, because it is very difficult to create illusions about the bottom line statement. You just, hey, if you lost 10 grand, you might be able to look at it and say, the minus sign isn't there, and put a plus sign in your mind. But otherwise, it's pretty difficult. There's a lot of ways that we can create illusions about what's going on in our everyday lives. It's real tough as traders. You hear traders talk about, meditating. This is the reason why. Because meditation gives us a heightened sense of self-awareness. Meaning that what you're doing when you meditate is you can learn to become an objective observer to your own stream of thoughts. Because those thoughts have significance. And they'll give you indications as to what kind of state of mind you're in and what you're about to do. That may or may not facilitate your goals or be appropriate. You talk about traders who keep journals, traders who used to be losers, went to the threshold, got to the threshold of consistency, and one of the reasons why is because now they're copious journal people. This is the reason why. Because keeping journals will give you clues and give you clues as to where you are, what your state of mind is, and what other agendas might be asserting themselves on your ability to see the market from an objective perspective. So we have to Yeah, so is everybody, I just want to get a sense, is everybody really clear about the fact that we have to acquire a particular state of mind that allows us to trade without fear, and that analysis is not going to accomplish that? It seems like it can. Every time we do analysis and we put on a winning trade, or we put on a trade and the market goes in our favor, it seems like analysis has done what it's supposed to do. And it's not that can't happen. It's just that there isn't the kind of relationship between the outcome and the reasons why you put the trade on in the first place, where you can make that connection. It isn't real. It's an illusion. We're getting into that right now. I just want to make sure that we're all together on where we're going here.